It's good to be back with another exciting podcast. In the last couple of weeks, we've delved into a number of instruments available to the borrowers. And of course, we've looked at this from the perspective of the entity borrowing as well as the perspective of the bank. Today, we continue with our story on bankability. And specifically, we talk about creditworthiness in relation to borrowing. How important is the element of creditworthiness? We are back with our usual expert analyst on these and many matters, and that is Crispin Daka Sidik. Sidik, good to be back and welcome to this exciting podcast.
Oh yes, indeed. So exciting. I always look forward to this moment for us to talk all things business and bankability, especially because, like we've said in the past, without debt as part of your capital structure, then you can't grow, you can't scale. So yeah. So we find that we know that this is the biggest enabler, and therefore that's why we are focusing on it quite a lot.
And it's interesting because one person made a comment that you guys are trying to teach people to borrow. I found that as an interesting aspect. I said, no. In fact, we're trying to teach the people not to fear borrowing, but also we're not trying to, make them borrow without taking, careful steps before you actually expose yourself to borrowing. So he then looked at me and said, I think that makes sense. So it's good also to get some feedback from the people that follow the podcast. And that is why we're here, CD. I'm sure you've received a similar feedback from the public.
Absolutely. So, and especially for me, like somebody who's really been a big advocate of saying, look, debt, and especially consumer debt, I say consumer debt, you should never go for it. And it's been the same. And that's our goal. Our goal is to say, look, play the game. We can't change the rules, but let's play the game. And we want to share with everybody else so that they can play the game properly and even play to win, as it were. Because without debt, we can never have a significant impact. I was speaking to one of our elders, Mr. Charles Matt, yesterday, who gave me a bit of background about our capital markets and what's happened and what we need to do. And it came down to one small issue where he said, look, most of the Zambian growing businesses do not scale over time. So for a few, they never scale over time. Why? Because either one, they got into debt and they didn't structure it properly, or they never even utilized debt at all. They've never even utilized debt at all. Our stock market has never been approached. They issue their bonds, you can issue, and all sorts of issues, but it's never been utilized. And as a result, you find that our biggest economic driver, which is the SME sector, is really very stunted. Like it's very, very small, even when you look at the kind of revenue, the size, when you just measure it by revenue, which is a disadvantage. Because I'm sure you can attest with me, like for instance, the partnership we have with Growth Investment Partners. Growth Investment Partners are saying, we've got money. We want to give money for projects, for building manufacturing plants, for doing anything, for import substitution. But you saw, they're talking of minimum turnover. Okay, so you should really be talking of something like $1 million or thereabout, $1 million. Thereabout the minimum assets you need to have. So all that, to build a business to that level, you can't just do it with own money, which is equity. You actually need the loans. You need the finance to scale to that level. That's why we're saying for lack of a better term, it's a necessary evil. So, but we can do it responsibly and we can play to win.
Excellent. Excellent. And I'm sure in the upcoming podcast, we'll be talking about the capital markets, we'll be talking about all those instruments, and it will be exciting to invite seasoned experts like Charles Mate and many others who actually are domiciled in Zambia to come and share their wisdom on why it's important for businesses to pursue these instruments to raise funds, whether for their operations or indeed to fund certain aspects of the business. Now, Sidi, just a recap. We talked about a number of aspects in our podcast. Last week we talked about the financial strength of the organization, competence in management, and the aspect of risk. What struck your mind most about what we discussed on our podcast last week?
Yeah, no, I think for me, it's been a very gradual, and we've really been very deliberate in the way we have been building this up. So we started the issue of saying, is debt bad or good? And then we've given the argument of saying, it is what it is. We need to make sure, it's how you structure, how you execute, and your mindset, and what you use that debt for. Use debt to buy an asset. Don't use debt for consumption. It's like that has been our biggest message. Then we've talked of the preparedness, from the governance side, from the financial numbers, and what numbers tell you, and what from the bank side they are looking at, so that you are because for them it's about risk, the probability that you are going to pay them back, so that you position yourself, package yourself, that you are a safe bet for them. So we've gone through that, and then today, like you said, we continue and we talk about the value of your credit history. Your credit history is very important.
Great. Let's get into it and just start from the top. In your just general explanation, what does it mean to be credit worthy? Obviously, it's one aspect of being bankable, and sometimes it's mistaken to be bankable itself. It's obviously one of the aspects. There are many different things that you spoke about that we've covered in our podcast. But what does it mean to be credit worthy? For a person to be, you are reputable. You can walk into any organization. You don't have cobwebs in your closet. You don't have issues from the past haunting you. Just break it down for us.
Yeah, so this comes down to the issue of your credit history. So your credit history, in terms of how have you performed on the obligations that you've had in the past, that is very important. And that's the other reason as well, as a business, because as a business, you may not need credit now, but you certainly will need it for you to scale after you reach a certain level of growth, right? So you need it. That's why you actually need to get into the debt game, the issue of being a borrower much earlier, so that you can build that history, because that contributes significantly to how the bank profiles you. So for me, we need to consider our credit history, our performance. So whenever we now commit to a facility, we need to make sure that we meet those obligations no matter what, because it's actually an asset. We should just consider it just like we have customers, we have, inventory. Your credit history is actually an asset. So it can either enable you for the future, or it can be the blocker to your growth. Yeah, and this is not just about, no, I missed the payment and then I ended up repaying and what. No, it's an issue of how you managed that whole facility. And why this is critical is that, and I'm sure a lot of the people, even on a personal level, and now it's almost like intertwined, because our credit reference bureau doesn't keep credit history of the company. No, it keeps the credit history of the
Of the
people. So
individual.
in this case, like the directors and those are the people on whom the record of the business is going to fall. Yeah. So they'll go and search for Crispin Daka, who is so they'll go, oh, who is in the directorship for Moore Zambia CFS. Oh, there is Reuben, there is CD.
Kumbuzo.
Then those
Yeah.
are the ones they need to go and do a search for. They won't go and search for Moore Zambia CFS. No, they will go
You
on
not
our
find
record.
it. Yeah.
Yes, they will go on our record. And then you find that most of these facilities, pretty much, I think all of them, and for them that even go for growing businesses, they ask for personal guarantees. So you read through the whole thing. One of the documents you are going to sign as part of your loan application will be some form of personal guarantee. If you've noticed, they'll ask you some assets, some liabilities, sort of a personal
Declaration of
balance
support.
sheet,
Yeah.
and
Correct. Yeah.
you'll sign some sort of personal guarantee.
Yeah.
So all that forms part of your credit history. And not to go too technical, but there are some period of time when that record has to be kept, where they keep it with the names, and they, I think after some time, that's when they anonymize it, like where they now remove the names. But for some considerable time, like something like 6 years or whatever, they would keep it, like some of it for 6 months. I think except there are some exemptions, but that's how important it is. That it's a great input into the bank's decision. I've seen facilities deny. The person can afford, they meet all the criteria, but because there was a negative credit note on their
Not
name
what they-
with the credit reference bureau, the facility was denied. So we can't give you the facility because you go and resolve the issue with the credit reference bureau. And as a side note, I would even want to encourage everyone, especially the entrepreneurs and everyone, all business owners, even on a personal level, at least every year, make sure that you can get the reports are free. You can request for a report, your credit report, from the credit reference bureau, where because sometimes somebody might have put some there. Oh, these are computer-based systems. Somebody maybe has a similar name like yours. What when updating, they updated on your name instead of that other person. So you find that without your knowledge, you have a negative report on your profile. So it's a very good idea, and this is something that within the bankability and CFO, fractional CFO, would support to make sure that as we are preparing your application or preparing for your loan, we even check with the credit reference bureau so that is there anything that we need to deal with. Don't let it come from the bank, because when it comes from the bank, it's too late. Then it means they've already assessed you as being too risky. Yeah.
Excellent.
Yeah.
Excellent. Now you talked about it's important to start to get into the culture of borrowing, early, so that you get into this CRB database. Now there is the element of people that want to just stay away. They've never borrowed, they've never approached a financial institution. Is that also a risk, not to borrow, because there will be no data anywhere that you ever borrowed, and so the bank will be looking at you. Is this a person high risk? Is this a person low risk? They don't know. What's your take on this scenario? Because it can go either way. The fact that you have not borrowed doesn't mean that you're in good standing. There is no basis for the database to rank you either bad or good. Your take on that one, CD?
No, that's a very good point. That's a very good point. And by the way, the Credit Reference Bureau, the major thing is they only get the exception. So, but having the fact that you've borrowed, you have a history of borrowing and you have no negative report with the Credit Reference Bureau, so that when you go there, you will say, can you give me my profile? And they tell you there is nothing, there is no recorded default. For me, even when the bank, because the banks actually have an arrangement with the CRB, so they just do it directly. So as part of the documentation that we sign in the application, there's even consent where you consent that you can go and check on my credit reference if there's anything recorded with. So if you've borrowed before, if you have a history of borrowing and you don't have a negative report, then that even strengthens your application. Yeah, so you're right. You need to get into it early so that you start developing that confidence, because now it's a relationship. You want to be an ideal borrower for the bank, so that whenever they look at you, even deals will now start coming your way, where they start asking you whether you want money or not.
Excellent. There are some businesses that typically they've held a very good payment history. For example, they've borrowed 3, 4 times and they've never defaulted at all on any facility. In a particular borrowing, circumstances hit them, they default twice. This obviously, is marked as a dent on their reports with the CRB. How do you treat such scenario and what are the remedies available to businesses like that? It's not their wish. For example, they rely heavily on 1 or 2 customers. Like you said, you talked about what is your profile of customers in 2 episodes, before this one. Now, this customer is usually a good payer over the facilities. They've paid over the past 4 facilities, and here they are. They've defaulted on the back of one of their big, customers going best, and so they cannot service their obligation. How would the bank look at this scenario, and how do they get out of this situation as a business?
Okay, yeah. So for me, just to address that, then I'll now go back to, because I believe in much more having to do preventative actions.
Yeah.
So when the default has actually happened, for me, what is important is don't wait for the bank to be, because, in fact, for the reference bureau, they only get involved if it becomes irrecoverable, meaning you have said you are not going to pay back at all. Yeah, you are unable to pay back. Then that's when it goes onto your record, when it becomes delinquent. But that's my understanding. But the issue with default can happen. It's part of the process. But what we need to do is, what should we do before, so that we can manage even the issue of the default? So before we can park that for the time being, let's just go back to what you need to do so that you can manage the issue of default. The first thing, RK, is what we call the moral hazards. Make sure that the loan proceeds, the money that you get through the loan, are used exactly for what you borrowed it for. That's number one, okay? You need to make sure that you use it exactly for what you borrowed it for. Not even a way should go anywhere else. Because when you were coming up with that loan, there's a particular business idea that you had, and therefore you requested that kind of money to generate that amount of cash or value, which should be enough to pay for the loan. Okay, so we call it a moral hazard. So I've been in scenarios where I'm advising somebody goes to borrow and they use that money to pay some salaries. Like in this case, it was more like, without going into, because if I give exact numbers, then it will be like, but it's more like this. You have a 10 million machinery you want to buy. Okay, Then from there, there is a shortfall in the operating expenses, including payroll, what. So that whole thing is 10 million, right? The asset, 10 million. There was an issue with internally and whatever. They decide to use 1.5 million to meet the salaries and all these, and even some other overdue suppliers, that were impacting them. So they remain with 8.5. They pay the supplier. It was not on terms. So the supplier supplied the equipment but could not install because the supplier said, we need the 1.5 for us to do the installation. So that asset, it was a plant. It was brought in but could not be installed. Meanwhile, the time to start repaying. So because it was not installed, it could not start producing.
Yeah.
The time for repaying the installments have reached.
Yeah.
And now you can't pay because the asset is there, but it's not producing.
It's not performing. It's not
performing. So now you have to find money to meet that. So for me, that's the first thing. That's how defaults usually happen. When you have what we call the moral hazard, you use the money for anything other than the purpose for which you bought it for. So that's the first. The other thing is in execution. For me, I actually encourage, especially if they're receiving the loan proceeds, don't receive your loan proceeds into your operating account. Warehouse it separately, okay? So that then you can have account for, from there, you only pay for something that is related to the project that you have borrowed for, yeah? So that you make sure that, so that then sorts out. So in the execution, it's very important. And then when preparing then there's the issue of building up your reserve. You need to start keeping some installment. You need to be ahead of your installment. So you need to start keeping up a specific reserve, which covers. So initially, you probably would not be able to, like on a month by month, be able to save the full. If you can't to save the full, at least even if 50%, even if it's whatever. So those start building up so that you have a reserve where even after maybe 3 months or 4 months, you have 2 months covered in your reserve. And this is not a general reserve. This is a reserve specifically because things do happen where a customer doesn't pay or something happens that was unexpected. You should be able to you should be able to use that to cushion. But again, even when you have done all of these things, still it's business, it's life. The asset has failed to perform. Be proactive. Go and engage with the bank, with the financiers beforehand, because there are solutions. There are solutions. You can go into, some of them agree on some moratorium, some payment holidays, some whatever, or worst case, you can even talk of refinancing. Yeah, refinancing. Yeah. Then the other one that I like, though you need to be very careful with this one, is that especially when your cash flows are not very predictable. Sometimes you have a lot of excess cash, sometimes you don't, and keeping a cash reserve is probably a bit difficult. See whether you can pay a bit more so that, because all that, the way the loans are structured, if you look at the amortization schedule for the loan, you see that yes. So it's the same repayment amount, but in the early stages, you are actually, the biggest component of what you're paying is
the interest. Yeah.
Only a small amount is the
principal amount.
Is the principal amount. So depending on how the loan has been structured, and make sure that there are no penalties for early capital repayment. In those months when you have some bit of excess cash, pay a bit more than your installment, because that goes to sit on your on your account.
Yeah.
As long as they're not penalizing you for early repayment. If they're not penalizing you for early repayment, and so it's an issue of reading all that. But these are some of the things as well. We help everybody understand so that we tell these are the implications of the agreements, so that as you are having to this month, if the cash flow is not very predictable, yes, you have a bit more excess. Instead of just putting it into a reserve, you are even better off just paying a bit more than your installment. Yeah. Or you can even say, okay, let me pay 2 installments at one go. Right. So you do that, and if you continue meeting that, then you quickly chow through the interest, and then you start
You started taking the
going towards
principal.
your capital.
Yeah.
And because most of these facilities are computed on the outstanding balance basis, so you find that even you can even manage your interest going forward. Yeah, but again, there you have to be a bit more careful, just to know that that's it. So that's what I would say, RK, that for me, prevention is better than cure. But should it happen that you've tried all these things we've done in this life, you need to be able to be proactive. Don't wait for the bank to come and say, hey, we are sending you a demand letter or whatever. Then you are too late in the game. You need to be proactive. You need to say, hey guys, when I look at the way things are going, the next 2 months are not looking okay. I'm unlikely. What can we do? They'll always have a plan in terms of this is what I can afford, or this is what I can do, this is what we can do. Like I said, you can have a moratorium, you can do some restructuring of the facility, or indeed they can even refinance it. Yeah. So refinancing, effectively, they give you money to pay off that one and give you like sort of you start, but again, you just need to be careful that it just doesn't create, because like we said, because if they do the refinancing, it starts now. Remember, you pay interest ahead of capital component. So again, you end up, whatever you will have paid will just end up all being consumed as part of the interest instead of really helping you. Yeah. So so for me, I think that's the key part where we need to take these proactive moves, and that's where having visibility on your numbers, forecasts, having budgets, having management accounts that you can see, you can tell, because then having a 13-week rolling cash flow forecast, it's going to tell you, oh no, somewhere there we're going to have a problem. Yeah.
Excellent, excellent, CD. And that takes me to the issue of some of the services we provide. You touched a bit about, fractional CFO and other services that we can proactively offer to the business in order to avoid the scenarios like the one we're discussing, where you get into a situation where you have questionable, your credit worth. And also, it helps organizations or business know key ratios. For example, the ratio we're talking about that could be critical at this point would be debt to income ratio. But this is something that the business should not worry about. This is something that we do the heavy lifting. You can go on with your daily business. We'll do it for you, and we'll give you the red flags. We'll tell you, your numbers don't add up. You cannot borrow this amount. We'll do the what if analysis. Just a bit into the detail of what we're able to do for business, so that when they submit an application, we could have done the panel beating, would have done the fine tuning, and what they submit is a near perfect application.
Yeah. So we start from, other than the basics, making sure that at least from the compliance side, everything else is in place. We then focus, like, related to this is the issue of how much debt can your business afford, including what you need to use it for. And we do that by doing the scenario analysis. So we do a forecast, and then we do a scenario analysis where we say, okay, if we are optimistic, this is like this. If what we expect, what we call the best case, is gonna be like this, what's the worst case? But we include a fourth one. For us, we even call it the stress. So when we say stress testing, is more like saying, okay, if things, because on the other scenarios, it's pretty much saying, okay, sales fall down, expenses do this. But on the stress testing, we want to look at what is the worst thing that can happen.
Yeah.
What's the worst thing that can happen? And what does that mean to your debt repayment capacity?
Yeah.
So that then from there, we can advise and say, look, at this point of where you are with the business and the risk that you are taking in terms of where you're going to invest this money, this is the amount of debt that would be sustainable, even in a worst case scenario. Yeah, even in a worst case scenario, you won't have a problem. You won't fall into the problem of permanent default. It would be something that you can manage, navigate through. Yeah, so that's the first thing that we make sure we try and do. And then, of course, we support all of that with the evidence. And then when it comes to execution, we're there through our fractional CFO, where we start with your sales side of things, the sales engine. We want you to understand throughout, what is your sales math? How many leads do you get? Or first of all, we start from the number that you want at the end of the day. From this number, based on your past performance, how many leads convert into whether it's orders or whether it's whatever, and finally they convert into a sale, so that we know how is that sales math. Where do you need? Is it because you don't have enough leads? That's why you are not hitting that number? Then we can help you with your sales strategy. So, and even that, we quantify it in terms of what you need to do. Then we've got the CFO, fractional CFO, which has a finance ready as well as a compliance component. So we help you do the budgets. Then we help you do the management accounts. We help you with the 13-week rolling cash flow. We help you with your compliance. At the end of the year, we help you prepare the financial statements that you then can give to the bank. So management accounts are on a month-by-month basis. And that's where we even give you the key indicators, the key drivers, and what they mean. And that's where, if you have debt in there, we even have those key ratios and tell you this is what they mean, and this is what we can do to improve this, so that we are being proactive, as it were. Then, of course, the tax side of things, we give you a compliance status so that at any point in time, you are fully compliant. You don't need to worry about the issue of having your TCC suspended. Yeah. So we will check in the compliance, we even check the NAPSA, the whatever, and make sure if there are issues, we can proactively help you engage so that you don't have all these issues fall into cause a problem, as it were.
Excellent. Sidi, there's one aspect that is we just touched a bit on it. Obviously, we'll speak in detail about it. But, finance raising in an economy like ours is critical. It's a service that we offer. We know the people with the money, but we also know the people with the money. We should know the people with the money. What is our role in that equation? Very critical for infrastructure development.
Yes. No, absolutely. No, that's the exciting space we are in. So right now, we are positioning ourselves as a gateway for project finance into Zambia. And so we are appealing to everybody out there who has a project, and this is where we can work with you all the way from preparation, bankability preparation, which means we prepare, we give you advice in terms of what needs to be done. So why are we confident that that advice would result in a financial close, meaning you getting the money? Is that we've, as part of our more global affiliation, we've now partnered with the big boys. So we've got our partners in Dubai, Moore JFC Dubai, who are, have a great track record in deal making, in financial close, in raising finance, and they are interested in sub-Saharan Africa, and including Zambia, and we've partnered with them so that we can curate projects. So we curate projects. They've given us what their criteria is. We, immediately we profile the projects. We give them. They review them. They come back to us. They say, this is what you need to do. And once we do that, then they take it over, and they've got a very high success rate in terms of structuring deals. So that's a very exciting moment where we feel we want to contribute to the development of our country. We have very strong ambitions. We have 10,000 megawatts of electricity by 2031. That's a big gap to where we are right now. That needs to come on board. We are talking of 3 million metric tons of copper production. 2031 thereabout. The infrastructure, because if right now if we just look at what we have and how it's constrained,
less than 1 million, we can't carry that.
What about, and this is just 1/3 of what we
desired target, yeah.
Probably less than 1/3 of what we need to go. So the opportunity is big, and what I'm just, my appeal to the Zambian entrepreneurs is, this is now when we need to start thinking big. Let's think the money is there out there for big projects. Let's be innovative as locals. Let's create these projects. Let's package them. Let's put them together. Let's work together, get these projects packaged up. And then, we're there to play our role in facilitating the project finance that's needed to all the viable projects.
Excellent. CD, always good to chat with you. By the way, just to put it into perspective, Moore Global would be in the starting lineup of the world best 11 audit firm. And so it's not a small firm, it's big firm. So we're playing at the World Cup at the moment. So well done.
Absolutely.
So it's always good to chat with you and to have you on the podcast. See you again next week with another exciting topic.
Excellent. It's always a great pleasure to have this chat with you, RK. I'm forever so grateful.
Excellent. Thanks, and have a good day. Thank you.
All right. Cheers. Over now.
Cheers, man. Cheers. Thank you.
Yeah, cheers.
Cheers.